For the past few weeks, I've been dealing with some variation of the statement, "The market is up and my account is not." Strangely enough, it's commonly being positioned as exactly that, a statement of fact as to a question of why. Generally, as your financial coach and advisor, I really earn my fees when markets are down. I manage to coach my clients and keep them disciplined. I would contend that it is relatively easy to be an advisor when markets are crushing it and accounts are making money hand over fist. However, it's not so easy on the flip side. As a coach and advisor, to keep my clients disciplined and uninclined to react, for example, to market conditions of 2008 and early 2009, have likely earned me my coaching fee for the life of the client. In light of the simple statement above, it seems now is one of those times. This is due almost entirely to the fact that the S&P 500 and the Dow are both flirting with and periodically achieving new highs, and simultaneously achieving abnormally high returns for the year. Let's look at the simple investor statement, "The market is up and I'm not," and put it into context. In my typical coaching response, which market? The S&P 500 is 500 companies or stocks. That's it. This is hardly indicative of the market. The market as I see it includes domestic and international equities. It consists of large cap, small cap, micro cap, value, growth, emerging markets, emerging small cap, and emerging value. Additionally, let us not forget about fixed income, short term, to be prudent. Your portfolios hold 19 distinct asset classes, more specifically, asset classes that have low correlation. Remember from our coaching classes, correlation is when one stock or asset class goes up while another one goes down. Our portfolios are engineered so as to not be dependent on any specific asset class. This lack of dependency is designed to attempt to maximize your return for your given level of risk. The goal here is to get an overall market return. This approach, in conjunction with adding client-specific amounts of fixed income, is designed around risk reduction and insulates clients from the downside risk associated with holding one or just a few asset classes. The consequences of this more prudent strategy are that investors should not see returns that are associated with the lowest performing asset classes. And to the contrary, it would be unreasonable expectation of investors to be hitting home runs associated with consistently being in the highest performing asset classes. What is a reasonable expectation is a return equal with that of the asset classes with which we are invested. A market noticeably tilted towards small and value. This is where academically proven market premiums come from. Generally, this strategy is rather unassuming and extremely satisfactory. Unless, of course, the highest performing asset class, the S&P or the Dow, both of which are in investors' faces on a daily basis, courtesy of the news media and their forensic cocktail parties. This is what you're dealing with now. This is the battle that as a coach I face daily. So the investor statement of fact that the market is up and I'm not is inherently flawed when dealing with our portfolios. But in the absence of education and comprehending how markets work, it's very understandable. The perception of underperformance or not seeing portfolio gains like the rest of the herd inevitably leads investors to portfolio envy. They feel the need to react and make changes to their portfolios. Unfortunately, this strategy is exactly the wrong approach. It's worth remembering that there will always be an asset class that is outperforming all the others, as well as some underperforming. When it's the S&P 500 or the Dow 30 though, everyone notices. They notice due to media spotlight and because in my educated opinion, it makes up a disproportionate percentage of many very poorly diversified portfolios, thus making the news sadly relevant. While some may be inclined to get on this train of seemingly skyrocketing returns, the S&P and Dow have offered thus far this year, the wise and coachable clients know that volatility works both ways. The risk is twofold. What goes up can go down. Now that the S&P has appreciated, there is a legitimate risk that this ride may soon be over, and that any material changes to one's portfolio in this direction may be poorly timed. In other words, the ship may have already sailed. This is the risk of market timing at its very core, and the reason actual investors' returns frequently do not match fund performance. Investors see an asset class appreciate and then buy, often too late. Once in a while, they frequently get the luxury of the ride down and then panic and sell for a loss. Then they look around for the next hot asset and repeat. Think the tech wreck of 2000-2001, the housing bubble, and on and on. If investors are doing anything at this point, they should be doing the counterintuitive selling of the heavily appreciated assets and buying the less appreciated or depreciated assets through systematic rebalancing, just like we do on a quarterly basis. Discipline is not for the weak, but success is the long-term reward. Specific to my clients, no matter the current state of the S&P 500 or the Dow, know that you are in a portfolio that is designed to dial into academically proven dimensions of return, including small and value premiums. And that with respect to those asset classes, you are getting similar asset class market returns. In the meantime, sleep well at night knowing that your portfolio and your coach are doing exactly what needs to be done. I'll be here looking after your best interest and coaching you, my clients. Your portfolio will be spitting out risk-adjusted market rates of return just like they are supposed to. I hope this helps everyone understand a little bit better what we're doing and why, and calms the follow-the-herd instinct that is prevalent in society today. If you have any questions, comments, or just want to talk, please don't hesitate to call me. I'm here to listen and, when necessary, coach.